The 30-year U.S. Treasury yield just hit its highest level since 2007. A lot of you will remember sort of the significance of that year, and that matters way more than most equity investors seem to understand right now. Another thing to note, the bond markets across the world have moved in the same direction at the same time. 30-year yields in Canada, Germany, France, Spain, Portugal, the Netherlands, Switzerland all hit 12-month highs. So what is driving this, and why do I think it matters so much? Let's take a look at that. Let's look at some numbers here. U.S. inflation came in at 3.8% last month. Core inflation up to 2.8%. Producer prices rose to 6%. Fuel oil prices are up more than 50% year over year. Now, when you get that kind of persistent price pressure, it changes the way the market thinks about interest rates. At the start of this year, the market was pricing in a 96% probability of a Fed rate cut at some point during 2026. Today, the odds of a rate hike before the end of the year have climbed above 40%. So that is a complete reversal of expectations in a very short period of time. So let's analyze this. The crisis part of this all is how the bond market is reacting to everything that's going on. The US 10-year yield, as I mentioned, almost hit 4.7% the other day. That's the highest since early last year. The 30-year yield hit 5.2% last week. That is the highest since July of 2007. HSBC, they describe these levels as a danger zone, meaning that yields have risen to the point where they start generating stress in other parts of the market. And if we believe a recent Bank of America survey, this might not be the ceiling. 62% of fund manager respondents expect 30-year Treasury yields to reach 6% this year. And that would be the highest level since 1999. That's another date that might ring a bell. Now, here's why this matters beyond just the bond market itself, because I know a lot of people don't follow the bond market directly, but the 10-year yield, it effectively sets the floor for borrowing across the economy. When it rises, mortgage rates go up, auto loans rise, credit card rates rise, everything tied to debt gets more expensive. Now, there's also a national debt angle that doesn't get enough attention, in my opinion. The U.S. is now spending roughly $1 trillion a year on interest payments alone. So that's about as large as national defense spending, larger than defense plus federal education spending combined. And when debt service consumes that kind of share of the budget, it limits what a government can do when we do hit an actual downturn. Now, I want to trace that same logic through to the corporate side, and the AI build-out is a very clear example. Morgan Stanley estimates that the global data center build-out could require roughly $1.5 trillion of external financing through 2028, with private credit expected to provide more than half of that amount. And that matters because a big chunk of private credit is floating rate. So if rates stay high or if they rise further, then the financing cost of these AI build-outs are going to rise as well. And the risk there is that many of these investments assume that revenue is going to scale quickly enough to justify the enormous capital expenditures that we're seeing right now. Some no doubt will, but many won't. And if rates go up and revenue growth doesn't keep pace, then these higher debt servicing costs could become a real pressure point. And I suggest that is probably what we're going to see. That is the chain reaction that the bond market's pricing in right now. That's what we're seeing happening right in front of our very eyes. You got those higher yields. They compress the present value of future earnings. $1 of projected revenue a decade out is worth a lot less when you discount it at 5 or 6% than when you discount it at 2%. Growth stocks are priced almost entirely on future cash flow, so they get hit the hardest in that type of an environment. Now, the sequence from there is fairly consistent when you look at it historically. Speculative assets reprice first. Housing affordability deteriorates as monthly payments are climbing out of reach of buyers who don't have the cash. Private equity, commercial real estate, the regional banks, they rely on rolling over that cheap debt. They begin to feel the pressure. Eventually, consumers will pull back. The financing costs will start to show up in their monthly budgets in a way that they're not willing to tolerate anymore. So let's look at the bond market versus policy. Now, last April, you will remember, no doubt, we had that sudden escalation in tariffs. The bond market stepped in and forced that policy correction. It wasn't going to happen, but the bond market said, Mr. Trump, we have to do this. The 10-year yield jumped more than 50 basis points in 3 days, and that is one of the largest short-term moves that we saw in decades. And that was enough to put the tariff program on pause. In fact, it was the birth, I think, of the now famous taco trade. The question that we're asking now is whether this same mechanism will work again in the current situation, and the answer is probably not. At least it won't work with the same speed and the same effect. What we were talking about last year is a trade policy, and that can reverse with a tweet, with an X, with a Truth Social, with an announcement. But a military engagement, a war, obviously that's harder to exit. So that means that the bond market pressure might not translate into a policy change the way that it did last year. And if that is the case, then yields could continue to rise while the underlying driver, that conflict-driven inflation, stays in place. So let's look at the relevance here for investors. I think that equity investors have been amazingly calm through all of this. I think I want to take an honest look at that. We certainly have not seen the stock markets show the same level of concern that the bond markets are pricing in right now. And part of that is just sort of the natural disposition of long-term investors. We all know that historically a better bet has been to stay invested and stay patient. It's a reasonable stance. It's definitely one that I share. I'm not necessarily calling for a bear market here. I'm certainly not calling for an immediate crash, but I will say you also can't rule that out. Things can happen pretty quickly. And I don't think that we have certainty yet, but here's what the data does support. Bond yields are at multi-year highs across multiple developed economies at the same time. The probability of a rate hike has gone from near zero to about 40% in a matter of months. A significant share of the AI build-out sits on that floating rate debt in an environment where the rates are moving against it. And the policy mechanism that helped contain things last year, I believe, will be less effective in the current situation. Now, that is not a reason to panic, but it is a reason to be honest about how your portfolio is constructed, how much of it depends on continued cheap financing, and whether your positioning reflects the environment that we are currently actually living in. Keep watching the 10-year yield. Keep watching the inflation data. I would suggest monthly. Be clear-eyed. Have no misconceptions about what's happening to prices out there, because until that changes, the pressure on rates isn't going to go away. Hope you enjoyed the video. Don't forget to subscribe. Thanks for watching. We'll see you in the next video.